Brian Diaz with Score More Credit, and this is how your credit score affects your payments. We're going to take Brad and Jim. Brad and Jim are twin brothers. They grew up obviously in the same house, same parents. They went to the same high school, went off to the same college. They graduated with the same GPA. They both missed some payments throughout their college years, as most of us do when they're first learning about credit. Jim and Brad actually married twin sisters, went to work for the same company, got the same position. They decided that they were going to live in the same neighborhood and both looking for $300,000 loans to buy houses so they could be, the kids could grow up together. Okay. Jim, known to be a little bit of a mischievous one, he was in a rush to get the house right away, dying to get into the house. So when they both applied for their loans, they were both told they would get an interest rate of 9% because they both had 580 scores at the time. Brad, on the other hand, decided to get a second opinion. He went to another loan officer who told him, look, for a small investment, I can get your credit score. I have a guy who can get your credit score a little bit higher. And, with that higher credit score, you're actually going to save on interest. And, although it's a small investment over the course of a 30-year loan, it's really going to add up significantly. So Brad went ahead and took the time to go through the trouble of going through the credit repair, whereas Jim just jumped on the mortgage right away. His loan officer was happy to, slap a few points on the deal for himself and get the loan closed as quickly as possible. This is kind of the situation over the past few years, right? All right, well, let's take a look at what happened. After Brad was done with his credit repair, he had a number of inaccurate items on his credit report. He ended up with a 620 FICO score. Okay, again, they both had $300,000 loans. All other things being equal, Brad just has a slightly higher credit score now. Well, Brad ended up qualifying for a loan at 6.99% on a 30-year fixed, whereas Jim got a 9.024% on a 30-year fixed as well. Okay. Brad's payment came out to $1,994 a month, whereas Jim's came out to $2,419. That's a difference of about $425 a month. It's $425 a month that Brad has, Jim doesn't. Now, $425 a month, that's nothing to sneeze at, okay? Brad can go on vacations. Brad has more money to spend on his kids, on his wife. He's got money for a nicer car. Even for the same dollar for dollar, he can actually buy a nicer home. Whereas Jim's home's probably going to have, some dirt in the backyard and Formica countertops. Brad can afford a house with a nice marble countertop and a pool in the backyard. All other things being equal, just because he has a higher credit score, just because he has lower monthly payments. But Brad, he's not a fool. He's already proved that. He's not going to take that money and just spend it frivolously. Instead, he's going to take that $425 a month and he's going to invest it into a mutual fund. Now, this mutual fund has been, over the past 50 years or 20 years, has been averaging 10% annual returns. So taking that $425 a month over the next 30 years, Brad has another $922,000 plus dollars with which to retire that Jim doesn't. What other investment do you know of that for just a few $1,000s or even less can get you a return of $922,000 plus? None.